In crypto circles, you're going to hear the term stablecoin thrown around a lot. Despite the multitude of issues surrounding them, and trust me, we'll get there, stablecoins are becoming increasingly prevalent in the cryptocurrency market. It feels like almost every week there are new stablecoin advancements and improvements being announced by protocols, businesses, and marketplaces that ensure stablecoins have a place there. But why the boom? And what exactly are stablecoins? Stablecoins are a type of crypto, but their big differentiating factor is that their value is linked to that of a traditional currency, for instance, USD. The rationale behind this is something like, why risk your money with coins with values that rise and fall dramatically when you can just invest in a coin that is directly backed by the value of something else? Traditionally, stablecoins are believed to be a bridge that allows traders to go from one cryptocurrency to another. So how exactly do stablecoins work? Now, obviously Bitcoin is the most popular cryptocurrency out there, but it's been known to fall victim to some short-term volatility. For example, in 2017, it moved from around 5,950 in November to 19,700 in December, then back down to 6,900 by early February. The cryptocurrency's intraday price fluctuations are sometimes extreme. The coin may fluctuate by as much as 10% in each direction within a few hours. The public may prefer not to utilize popular cryptocurrencies like Bitcoin because of this short-term volatility. Simply said, money should serve as a means of trade and a store of wealth. They aren't confident in its future buying power, and it should hold its value better over the long term. Users will be less likely to embrace it if they aren't confident in its future buying power. Ideally, a cryptocurrency should have a stable value and a minimum level of inflation, making it attractive to spend rather than hoard. Stablecoins help with this goal. Now, the popular stablecoins are cryptocurrencies like Tether, USDC, and DAI. Let's go over them one by one because they all have important attributes you should know. Let's start with Tether. Tether has a commanding lead over other cryptocurrencies in trading volume, eclipsing even Bitcoin. The amount of money traded in Tether, USDT, during your average 24-hour period is often sometimes double the amount for Bitcoin. However, Tether is one of the most contentious projects in all of crypto, due to the remaining concerns about how Tethers are backed and accusations that they're used to actually artificially inflate the price of Bitcoin, and that Tether investors would be unable to divest themselves of their holdings since the pot is empty. Tether used to claim to be fully backed by US dollars, but Tether now claims to be backed by other assets, such as commercial paper. The optics problems that have affected Tether have provided Circle, the firm behind USDC, a chance to challenge the established status quo of stablecoins. Publicly, Tether is happy to have competitors, but the numbers state that Tether's market share is heavily being eaten into by a more legitimate quote-unquote stablecoin. The USD coin, USDC, which was developed by Coinbase and Circle, is an asset designed to reduce transfer times, simplify transactions, and make the conversion of USDs for digital currencies more accessible to customers. Circle is much like Tether in that it too has issues. Following the revelation that Tether and USDC were not 100% cash-backed, criticism that USDC was not a genuine stablecoin arose afterwards. More recently, Coinbase's Lend program has led to an SEC investigation into Coinbase and its USDC offerings. DAI is a cryptocurrency that seeks to maintain a value of $1 per coin via use of smart contracts on the Ethereum network. DAI is an open source, decentralized stablecoin whose ownership is vested in MakerDAO, a DAO in which participants may vote on modifications to its smart contracts. This is done to guarantee the stability of DAI. DAI and MakerDAO have been regarded as the first major instances of decentralized money in use. DAI is unique in that it does not advertise that it is backed by US dollars. Furthermore, DAI is supported by Ethereum and the collateral that is included in the smart contracts that underpin it. Now, why exactly are people so concerned about stablecoins? The simple answer is that the government might be threatened by anything that could debase fiat money. Stablecoins, because of their connection to less volatile assets, are purposefully safer than normal cryptocurrencies, but US authorities do not seem to agree. Sources close to the US Treasury Department and other government agencies have previously told Bloomberg that the Financial Stability Oversight Council is working on a crackdown on stablecoins. It's believed that regulators are worried that the cryptocurrency's unregulated nature poses a significant threat to the banking system. But what are your thoughts? How do you feel about stablecoins? Do you think they go against the very idea of DeFi, or are they just another aspect of crypto? Please let me know what you think in the comments down below, and if you enjoyed the video and want to support independent tech journalism, consider subscribing to the channel. Thanks for watching, everybody.